You put $50,000 into a product that promises you'll never lose money. Fixed return, no market risk, guaranteed. Most people think they've eliminated risk entirely, but what actually happened is you traded one kind of risk for another, and someone else is making money on both sides of that trade. Guarantees aren't free, they're profitable. When a financial institution offers you certainty, they're not absorbing your risk. They're pricing it, managing it, and profiting from the difference between what they promise you and what they can earn elsewhere. The guarantee is real. You will get what they promised. But the way they structure it ensures they make money whether markets go up, down, or sideways, and you give up access to most of the upside in exchange for avoiding the downside. This isn't fraud, it's a business model, and it works because certainty has psychological value that exceeds its mathematical value. Let's start with the simplest version, a certificate of deposit, or CD. You give a bank $10,000. They agree to pay you 4% annually for 5 years. At the end, you get $12,166, guaranteed. Here's what the bank does with your money. They don't just hold it, they lend it out at higher rates. They might issue car loans at 6%, mortgages at 7%, business loans at 8%. The spread is their profit. They borrow from you at 4% and lend to others at 6% or more. The difference, 2%, 3%, sometimes 4%, is what they keep. And they can do this because your money is locked in. You agreed not to withdraw it for 5 years. That gives them certainty too. They know exactly how much they have to work with and for how long. If you need the money early, you pay a penalty, often 3 to 6 months of interest. That penalty isn't punitive. It's designed to recover the cost of disruption. The bank already lent your money out based on the assumption you'd leave it for 5 years. From the bank's perspective, your guaranteed 4% is cheap, stable funding. They're paying you less than they earn, and they know exactly when they have to pay you back. From your perspective, you traded liquidity and higher potential returns for certainty and simplicity. The guarantee is real, but the cost is invisible. It's the difference between 4% and what that money could have earned elsewhere. Bonds work on a similar principle, but at a larger scale. A corporation or government needs to borrow money. They issue a bond. You lend them $1,000. They promise to pay you back in 10 years, plus 5% interest annually. You get $50 a year for 10 years, then your $1,000 back. Total, $1,500. Guaranteed as long as the issuer doesn't default. Here's what happens behind the scenes. The corporation takes your $1,000 and dozens of others like it. They use that pool of money to build infrastructure, expand operations, fund projects. They're betting they can generate more than 5% return on that capital. If they're successful, they might earn 10%, 12%, even 15% on projects funded by your money. They pay you your 5%, keep the rest. If they're not successful, they still owe you 5%. That's the risk they take. But they've structured their operations so that risk is manageable. They've run the numbers. They know they can cover it. And if they can't, that's when defaults happen. But most bonds are issued by entities with strong credit ratings, meaning the probability of default is low enough that they can promise guaranteed returns without much real danger. From the issuer's perspective, bonds are a way to borrow money at a fixed cost. They know exactly what they owe and when. From your perspective, you've locked in a return, but you've also locked in a ceiling. If the company does phenomenally well, you still only get 5%. If inflation rises above 5%, your real return is negative. The guarantee protects you from loss, but it also caps your gain. Now, let's look at annuities, where the mechanics get more layered. You give an insurance company $100,000. They promise to pay you $500 a month for the rest of your life. Guaranteed income, no matter how long you live. Here's how they make this work. First, they pool your money with thousands of other people's money. This is called risk pooling. Some people will live longer than expected. Some will die sooner. The insurance company uses actuarial tables, statistical models of life expectancy, to predict the average. If the average person lives 20 years and they're paying $500 a month, that's $120,000 paid out on your $100,000. They lose money on you, but someone else dies after 10 years. They only paid out $60,000. They made $40,000 on that person. Across thousands of people, the averages smooth out. The insurance company isn't betting on you specifically. They're betting on the group. Second, they invest the $100,000, not in risky assets, mostly bonds, real estate, stable dividend stocks. Let's say they earn 6% annually. Over 20 years, compounded, that $100,000 grows significantly. They're paying you from a combination of your own principal and the returns they generate, and they're keeping the difference. Third, they charge fees, surrender charges if you exit early, administrative fees, sometimes annual fees of 1% to 3%. These are baked into the contract. From the insurance company's perspective, annuities are profitable because they control the investment strategy, they benefit from pooling risk, and they charge for the guarantee. From your perspective, you've eliminated longevity risk, the risk of outliving your money, but you've given up flexibility, access to principal, and most of the upside if markets perform well. And here's the part most people don't realize. If you die early, the insurance company keeps most of what's left. Some annuities have death benefits, but many don't. The money doesn't go to your heirs. It stays in the pool. The guarantee is real, but the trade-off is steep. There's a variation. Fixed indexed annuities. These promise a guaranteed minimum return, say 2%, plus potential upside tied to a stock market index, like the S&P 500. It sounds like the best of both worlds, downside protection and upside potential. But here's the structure. Your gains are capped. The contract might say you'll get 50% of the market's gains, up to a maximum of 6% per year. So, if the S&P 500 goes up 20%, you get 6%. If it goes up 4%, you get 2%. If it drops 15%, you get your guaranteed 2%. How do they afford this? They invest most of your money in bonds, safe, predictable returns. With a small portion, they buy options on the stock market index. Options are leveraged bets. They cost a fraction of the underlying asset, but allow exposure to gains. If the market goes up, the options pay out. They give you part of that gain, keep the rest, and pocket the bond returns. If the market goes down, the options expire worthless, but the bonds protect the principal. From the insurance company's perspective, this is low risk and highly profitable. They've engineered a product that limits their downside while capping your upside. From your perspective, you're paying for protection you might not need. If you can handle volatility, you'd be better off just investing directly. But if you can't, if the idea of loss keeps you out of the market entirely, this structure gives you partial access. The guarantee is real, but it's expensive. You're giving up most of the market's growth in exchange for a floor. So why are these products structured this way? Because certainty is expensive to provide, but even more expensive for the buyer. When an institution guarantees returns, they have to engineer the entire product to minimize their risk. That means conservative investments, careful actuarial modeling, and contractual limits on what you can earn. But they also know that fear drives demand. People will pay a premium in the form of lower returns, fees, and loss flexibility to avoid the possibility of loss. This isn't manipulation, it's economics. Certainty has a price. The buyer pays it in opportunity cost. The seller captures it in profit margin. And the system persists because both parties get something they value. The buyer gets peace of mind. The seller gets predictable revenue. Here's what this looks like over time. Let's say you put $100,000 in a fixed annuity earning 4% annually. In 20 years, you'll have about $219,000. If you'd invested that same $100,000 in a diversified portfolio averaging 8% annually, which is historically conservative for stock-heavy portfolios, you'd have about $466,000. The difference is $247,000. That's the cost of the guarantee. You didn't lose money. You got exactly what was promised, but you gave up nearly $250,000 in growth in exchange for eliminating the possibility of temporary loss. And here's the harder part: inflation. If inflation averages 3% over those 20 years, your $219,000 has the purchasing power of about $121,000 in today's dollars. You grew your money nominally, but barely in real terms. Meanwhile, the institution that sold you the product earned the spread, the difference between what they paid you and what they earned on your capital. That spread, compounded over 20 years across thousands of customers, is how they stay profitable. Once you see this, you stop thinking of guaranteed as purely protective. It's protective, yes, but it's also a trade. You're trading potential growth for certainty. You're trading flexibility for simplicity. You're trading upside for downside protection. And someone is making money on that trade. This isn't about whether guarantees are good or bad. It's about understanding what you're giving up and who benefits from the structure. The guarantee is real. The promise is kept. But the cost is built into the design. It's just not presented as a line item. The system works because both sides value different things. The institution values predictable profit. You value predictable safety. The gap between those two is where the money is made. When you see that gap, you stop asking, is this guaranteed? And start asking, what does the guarantee cost me?